All right, welcome everybody. So we've got a decent group here, 68 folks or so. Igor's just jumping in. So welcome today. We're going to have a great session. Goal today is to really walk through fixed income a bit with you. We're going to keep it at a little bit higher level today. Ed's got a fantastic video in the fixed income section here of the Discord that if you haven't watched it, it's a really great video just to get comfortable with, what is a T-bill? What's the difference between bills, notes, bonds, the different lengths of time, where you can source those things. I don't want to get into too much of that today. If we have time, I think we can certainly dive into that. What I see is a lot of questions out there. I'm going to let Ed run the show, so I'm going to shut up after this. But a lot of questions are, well, what do I do if I'm in a small account? What do I do if I'm in a mid-size account? What do I do if I'm in a PM account versus a Reg T account? How does this all work together with different account sizes and different account setups? And for some of you, it may not work at all. If you're in a small account with Reg T, this may not be something that you want to focus on because it may not give you enough room. If you're in an IRA, you may want to take a look at how an IRA is going to function different, especially if you're going to trade BIL, which is going to be cash secured. We'll get into all of that, I assume. So I don't want to touch base too much on that. But why does using BIL take up more of my margin? Why is it using margin versus cash? Because it's an ETF versus an actual treasury. So I think these are all good questions. And I'm going to let Ed jump in and take it from here. And I will monitor chat. If we come up with some great questions, then I will interrupt if need be. If not, we'll keep cranking. So Ed, it's your show.
Thank you, Tom. Thank you for the opportunity to do this session with you, and welcome to all the Mr. Top Tickers out there. It's been a pleasure interacting with you guys and gals, and look forward to continuing to do so. Tom and I spoke briefly before the session. We have kind of a loose agenda, which Tom basically went through. So we'll just go through things. I don't have anything set to key in on that you guys are looking at. So we're just going to go through some of this, and it'll fly. So feel free to drop your questions in the answer in the question the chat session. At the end, we're going to have a Q&A, but if anyone has questions during, again, we don't have an exact firm agenda here, so please feel free to jump in. So again, as Tom mentioned, we have done a previous video where I went through extensively a lot of the mechanics of BIL and T-bills and how to get into these things, and a little bit on the margin issue, etc. It's about a 2.5-hour video. I jokingly tell people to grab some popcorn and watch, and it's pretty informative. I'm going to pop it. We're in the fixed income room in Mr. Top Tick here. Now, I know there are a lot of new members who may not even know there's a fixed income room here. So we're going to go into that in a second. There's always also a section down here in the strategy discussion where there are some fixed income threads. Please feel free to go through that. Here is one of the locations for the first fixed income trading meeting that we had. Most of my info is here in the fixed income room just because it's more convenient for me to have all my pins and threads here, which I do plan on going through. And in that regard, I'd like to just do a brief overview of the T-bills and T-notes and BIL and SGov. BIL and SGov are T-bill ETFs. So we have T-bills, which are 1 year or less. We have Treasury notes, which are 1 to 10 years, and then Treasury bonds, which are 10 years and longer. Each of those has different margin requirements in our trading accounts. Now, whether you have a portfolio margin account or a Reg T account, which is a regular margin account, the T-bills get the same relief and the T-notes get the same relief. In a portfolio margin account, the T-bill ETFs, which BIL and SGov are pretty much the most common, get different margin relief depending on whether you have a Reg T account, whether you have a PM account, and what brokerage you have your assets. And even in the portfolio margin account, the margin relief you get from those fixed income investments varies by the brokerage where you do business. We'll get into that a little bit. I don't want to get too bogged down into that. Again, invest some time in that 2.5 hour video. I know it's obscenely long, but it's hard to compress all this in. And with that, let's get into here. I have some questions that Tom had sent to me. Okay, so Tom has requested that we go through like a $25,000 Reg T, a $300,000 Reg T, a $500,000 portfolio margin account, and $1 million and up portfolio margin account. And we'll do that. And I want to start by saying, and in fact, we can look at this, like Money Stream Dave asked me this question. He wants basically to go through these things. And, you know, my answer was the more variables you have crammed into an account, the more intricate and a little bit complex it is to determine the amount of cash you have to allocate these things. My general rule is look at your cash balance, and that's what you have to allocate. I personally don't go by the buying power needed in those in conjunction with your other assets. I like to determine the cash balance and then determine how much margin expansion you need if you're trading futures, which most people are, because futures need cash to trade. Indexes need excess margin buying power. So if you're trading futures like ES, all your commodity futures, bond futures, etc., they need cash. So when you're loading your trade in, you see that initial margin requirement at your various brokerage accounts. That's how much cash you need to start. And then that's an initial maintenance amount. And then there's a maintenance margin amount. And that varies by what's going on with that asset. If it's working in your direction, the margin will come down a little bit generally. If it's going against you, you'll have margin expansion. So I want to start by reiterating, with futures, you actually need cash. So, and portfolio margin, you need excess margin to trade with. I'm going to bounce to the portfolio margin for just a minute and reiterate what I'm talking about, because people might be pretty confused. Those of you who are trading futures only in a regular account or even in a portfolio margin account, you probably see your cash balance moving up and down. With a portfolio margin account, if you're not trading futures, which is what I am currently doing, then you can basically load up your whole account with fixed income, and you use the excess margin relief from those fixed income investments to do your trading. For instance, if you have let's use the $300,000 Reg T account first. So if you have a 300, and we'll go back to the 25 because it's a small account and there's a useful purpose for the fixed income there, but it's a little tighter. So on the 300,000 account, and in this room, people are typically trading somewhere in the 50% buying power, plus or minus 10%. And I know there's a lot of variation there, but I'm trying to generalize. So in that $300,000 account, if you're at 50% buying power, you're using $150,000 worth of cash to actually hold and maintain those positions. And again, as I mentioned just now, as the position goes in your favor, you've probably noticed that your margin requirement goes down. And if we have a margin expansion event, either the volatility increases or the position moves against you, both of those create a margin expansion situation, the veracity of which is determined by the velocity of the price change or the VIX change. For instance, like in March, when we had that huge volume expansion during the little mini banking crisis that we had, the S&P didn't really fall very much, but volatility expanded greatly. Typically, they go hand in hand. Right now, we're in a multi-year. I think I saw yesterday we're at a 4-year low on the VIX, which is like a little over 12 right now. I don't have it right in front of me. It's somewhere on one of my screens. But we're a little over 12. It was like 12.25 earlier when I looked. So volatility is very low. And therefore, there's a greater chance of margin expansion. Okay, let me get back into this. So back to the $300,000 account. You load your positions in according to your own individual plans. Some people schedule, some people use metrics, some people do both. And as you're building out your account, you're getting closer to that targeted buying power range, whatever it is. And then you're set. So let's say you're set and you've got your full book out there of whatever it is you're trading, and you're at 50% buying power. Again, you use 150 of your 300,000 in buying power. You then have 150,000 left in cash that's just sitting there. So before I started spreading the word in the various discords I'm in, people were content with just having it that way. There was really no awareness that there was another option. So the other option is you take that extra 150,000 in cash that's just sitting there, and you turn it into a new income stream for your account by placing that money either into T-bills, T-notes, or one of the T-bill ETFs, which again, BIL and SGov are the most popular. And you get the return on that. That's whether it's in a span margin or a portfolio margin account. You get the same relief on the T-bills, a slightly different one on the T-bill ETFs as mentioned. And then you work it from there. So you would not want to put your entire 150,000 into fixed income, because we have margin vacillation, margin wiggles every day, little margin waves that, you know, if the VIX pops from 12 to 13, your positions are going to move against you and your buying power needs are going to move up. So you need some extra cash in your account to buffer yourself against a margin call from over allocating into the fixed income. So I hope that's clear. I can stop and see if anyone has questions. No, okay, great. So
Yeah, just real quick. I mean, I think hopefully everybody's got it, and
yeah,
it was covered before. But if you're in a $300,000 account, and let's say we put on all of our scheduled trades and whatever trades we want to, we hit 150 grand in buying power usage. We hit our 50%. We still have technically that $150,000 of unused buying power available.
exactly.
And what Ed's
Mm-hmm.
and I trying to keep up and just put some stuff in the chat a bit too, but you don't want to use that, if you don't want to go over 50% buying power because of span margin potential requirements, which is what we espouse here, is that we keep 50% of our account open for span margin, especially when you're talking low VIX of 1241 today. It's up a whole massive 34 cents. If the VIX goes to 20 something, our BP is going to go up significantly on us. But in the meantime, you have all of that money left to potentially be put to use, but we don't want to buy more futures or anything that's going to actually use up the margin that we have. We've got a cash balance, and the goal here is to use, whether it's T-bills, T-notes, T-bonds, any of those types of things, to use against that cash balance, which essentially gives us a free income stream at this point in time while we wait.
That's exactly right, Tom. And again, as the original T-bill video shows, and as I've espoused in the Discord itself, different brokerages pay different amounts on our unused cash. At Tasty, it's like 0.01%. I haven't checked lately, but it was 0.01%. At Schwab, it's the automatic default sweep. It was 0.45%, less than 0.5%. At Ameritrade, it was a little bit lower than that. And at IBKR, Interactive Brokers, it's something higher. It's something like maybe 4.5 or 4.7%. You Interactive Broker, I don't have an account there, so I don't keep track of it on a daily basis. I know at Interactive Brokers, you don't earn anything on your first 10,000 in cash, or you earn that 0.01. It's a very low rate, but otherwise they're very customer friendly with the excess balance. So again, as Tom was mentioning, and I've reiterated in the past, the cash we have sitting there is basically being utilized by our brokerage firm to it's there for our purpose. It's there for our margin expansion, which will come at some point to some level, especially with, say, volatility at the VIX at these levels, or the individual commodities you trade. You see those have rising and falling volatility levels. And we've talked about, and I think I've posted here some of the different volatility indexes for things like oil and gold, as well as the VIX, which is the volatility index for the S&P complex, SPX, ES, SPY, XSP, and the micros. So again, it's kind of my pleasure to explain to people how to tap our own money and earn this kind of free income stream. I really don't know how to voice it. Instead of allowing our brokerage firms to use that money, and they're using it to make margin loans to people who trade on margin or need to borrow money from their account or whatever, and they typically loan that out at above 10%. I can't tell you exactly what it is. I'm guessing Interactive Broker they're pretty reasonable. I think they might be under 10%. And say Schwab and Ameritrade, they're like 13, 14%, which is more typical in the world. So they're basically taking our money that they're paying us 0.01 to 0.45 on and loaning it out. They're paying us those rates and loaning it out and making this huge spread. It's very similar to a bank. When you put your money into a bank, in your checking account or a low interest savings account, they're paying you that nothing or a little bit of amount, and they're making loans with that money and they make the spread. So it's just the same thing. So back to us in our brokerage accounts, when we learn the secrets, and it's not a big secret and it's really not complicated. It is at first, there's a lot of new lingo with it, some new terminology. I've found people are a little uncomfortable with it. It's probably very much, if you think back to the first stock trade, mutual fund trade, or especially option or futures trade you did, little hand on the mouse might have been a little shaky with that. You basically know what you're doing, but you're not sure what you're getting into. Unlike all those things, there really is essentially no risk to these fixed income investments. They are very short-term in nature. They're backed by the government, the full faith and credit of the U.S. government. We can debate how solid the full faith and credit of the U.S. government is. However, on a large scale on planet Earth, the U.S. government is considered the safest entity to place our assets. There are other AAA rated sovereign entities. A sovereign entity is essentially a country. Switzerland, Japan, I think, is AAA rated. There are a few others out there, but those entities do not issue enough fixed income in massive quantity for people to be able to store their assets into. Okay, I'm going to back off from that drill down and get back into it. Let's go back to our $300,000 account. So
before you jump into this account too, let's just do a quick, what is the difference between the BIL ETF and the actual T-bonds and notes?
As far as margin?
As far as, yeah, exactly. So let's go through, the difference between what is a T-bill, which is what everyone's used to talking about. We're actually buying either treasury bills at auction or something, or you're buying a bill or, ETF. Let's just use those two. What's the difference and how that can impact my buying power and my margin?
Great question. And please, Tom, feel free to keep my bumpers on. Everyone who's spoken to me knows I tend to go on and on. I don't want to drill down too much. I don't want to go off on a tangent. So please keep my bumpers on. I'm fine with that. So again, as I mentioned earlier, it depends on your brokerage account. At Ameritrade, for T-bills, which are 1 year or less, it's 1%. So if you have that 150,000 in cash, let's just say we take 100,000 of it and put it in any maturity of 1 year or less, including a T-bill ladder. And we can get into that, but there's some details in the Discord on that already. They hold 1% back. So if you put 100,000 in, they hold 1% or $1,000 in margin and release the other $99,000 for us to use for our trading in indexes and individual securities, which would be, for instance, SPX, SPY, even individual stocks, etc. So 1% The rest is released to us as excess margin, which we use for our trading. At the beginning, that's what I said I do. If you trade futures, then it's a little bit different. And I'll get into that in a second in more detail, even though I touched base on it. And I know this stuff is confusing, but if we spend a little time and invest that time, you're going to get thousands of extra dollars per year just by understanding this with basically no risk. And we'll get into that a little bit as well. So at Ameritrade, it's 1%. At Schwab, it's 4%. I don't really know what it is at the brokerage firms, but it varies a little bit. So Schwab's not quite as and this is whether you're in a span margin account or a portfolio margin account, it releases it, okay? So in that example, we have 100,000 in. I looked earlier, the 1-year rate's at like 5.14%. So that would, on that 100,000, we're going to earn $5,140 over the course of a year. T-bills are bought at a discount and gradually increase in value and mature for face value. Again, that's a little nuance that is covered in the T-bill video, the original one. So over the course of the year, just by taking 100 of that extra 150,000 and placing it into this 1 year or less fixed income security, and again, it can be a month. I don't know what the month rate is. It's probably somewhere around 5.2 or something like that. You'll earn that money over the course of a year, and poof, all of a sudden you're making $5 grand, 400 and whatever, $25, $30 a month just by waking up every day. So it's a great way to create this new income stream that rewards us instead of us, through not understanding, allowing our brokerage firms to make that money. Now let's drill down a little into that 150 extra, because I used 100,000 in that example. If you're trading futures and you have 150,000 that you've used in margin, you need to leave yourself a cash cushion for the margin wave, and you have to determine what a safe level is. So usually, but again, some of us are trading just ES, some of us are trading a whole variety of commodities. So it's hard to generalize how much margin expansion we may or may not encounter. On a brand new basis, I like to encourage people to take 20% of the amount of their used margin, which in that case, we've used 150,000. I would recommend initially, until you get your feet wet, leave 30,000 in cash and place the other 120,000, preferably into a 1 month or a 2 month or a 3 month T-bill, or a little tiny T-bill ladder where you get a 1 month, 2 month, and a 3 month type thing. Excuse me. And enjoy that and let that settle in your account. It takes a day for that to settle. I like people to look at their account once they've made their initial allocation. And we're talking T-bills. We'll get into the T-bill ETFs in a minute. Let that settle in and get used to looking at it and seeing how your metrics look with that cash allocation. I want to stop and deviate for a second. The reason I leave that extra 20%, which you can lower to 10% and even 5%, and even lower once you get an idea of what you're doing. So I've previously used the analogy of you want to allocate your cash into these investments in the way I'm describing, as if you were looking at a fire and it was cold, and you're walking up to the fire and you can start to feel the heat. But as you get really close to the fire, you don't want to put your hands in the fire because you're going to burn your fingertips. You want to stay just close enough to the fire to keep yourself warm. That analogy basically says you want to allocate into cash as much as you can, because at current rates, you can earn an extra 5% on that cash. So in the example we gave, if you have 120,000 sitting there, you have an extra 30,000 in cash, and after a week or two, you're comfortable with it, and you say, well, my margin went up to 155,000 and it went down, or it went down to 142,000. You kind of get an idea of how much volatility your individual account is having. And then you can additionally allocate a little bit more of that. So in that example, you might go from 120,000 allocated to 130. and then see how that extra 20 goes. And then maybe you want to chip away at another 10,000 if you see that your margin's not expanding that much. And again, just kind of keep putting those little pieces of your cash into that fixed income allocation, because at current rates, for every 10,000 you put in, you're earning about $510 a year, or about $45 a month. Again, it doesn't sound like much, but it's money that we deserve to make. It's our money. It's not the brokerage's money. So we should try to max allocate into that. Let's get into the T-bill ETFs.
So, and just again, bottom line, T-bills, it's only holding 1 to 4% of your margin, which means you have 96% or more of the margin of the T-bills available to trade equities, not futures, but equities.
Equity and index options, correct.
Yeah, and indexes. And if you're going to be trading, if you want to trade more futures, okay, then you now have to switch from looking at your looking at your margin to looking at your cash available balance, because futures are going to use your cash balance up. So if you've used your cash balance up in T-bills, okay, or if you have too much of it in futures, you're not going to have enough left over to cover all of you're going to run over your cash, and now you're going to start to incur margin interest.
Exactly.
Which is your key. So if you're trading, and that's why you see a lot of people, Ed and so forth, maybe trading using T-bills, but trading SPY and SPX, because again, those are equities and indexes, and that's not subject to the same cash, restrictions as futures are. If you start trading futures now using T-bills, and then we'll get into BIL here in a second, now you can't use as much, because you have to be aware of your cash balance. Anyway, that's my little quick summary. And
thank you. And again, we've touched on that, but it merits reiterating. It's one of the little fine points that you kind of have to just get your head around, and you will get your head around it. If anyone whose eyes are rolling in the back of their head right now, you may have to invest some time and re-listen to this. And there's an amount of fiddling to be done in each of our accounts, because they're all constructed differently. So in my case, where I have portfolio margin and I'm trading SPX and SPY, I don't trade XSP right now, but it would qualify. Those things use the excess margin that you put 100,000 in, 99,000 is thrown off. That's what my trades use. It doesn't work that way, as Tom just mentioned, I did earlier, with futures. So if you allocate in a portfolio margin account, you've basically, at 50%, you really almost won't have an issue unless there is some kind of massive blow up where your margin goes from 50% to something approaching 90 or 100% or more. Let's hope that doesn't happen, but it does happen on occasion. And at that point, you're using the excess off your fixed income. So even in a margin expansion event, let's say something crazy happens and the market goes down 15% in 3 days or something like that, your 50% margin in a portfolio margin account might mushroom to 70 or 80%. You really don't have to fiddle with your cash, because to liquidate your fixed income, you're only releasing that 1,000 for every 100,000 that you've allocated. So you're not getting really any relief to that margin expansion event. You basically have to deal with your positions, which comes to our individual plans. Are we stopping out? Are we rolling? Are we just taking positions off? Whatever are we hitting the exit button on everything and going to whatever everyone's individual plan is. Everyone has a slightly different plan. That's how we would react to that. So again, in that portfolio margin account, you can really allocate all 300,000. Maybe you want to allocate 295,000 to begin with, but you really can put the whole 300,000 in there and see how it goes. In the futures account, let's say we've taken that 120 and we built it to 130 and we built to 140. And we've got 10,000 and we have that 15% decline, and our margin goes from 150,000 to 180,000. Well, in that situation, you only have 10,000 in cash, but you need another, say, 30,000 or actually more, you need to cover that extra 30%, which would be 90 grand in a $300,000 account. So you need to liquidate your fixed income investment, whether it's a T-bill, T-note, or a T-bill ETF, and turn it back into cash so that your margin expansion, it's creating a margin call and it's creating a margin loan. So you want to alleviate that situation because you do not want to be paying that over 10% rate on the broker margin loan that I referenced earlier. So at this point, I want to kind of like go to these pins and just show some people, like here I say, if you properly allocated in your account, congratulations, you found your new free money income stream. Here's a big one. Don't hesitate to liquidate. There's no reason to avoid jumping in and out of these fixed income investments as needed. It's one of the main benefits of the T-bill ETFs. I'll get to that in a minute. The second is the great extra yield for your portfolio that your portfolio can produce with the proper allocation. Don't let it cause you stress in an elevated volatility expansion moment. That means if you wake up one day and the market is down a lot and your margin has gone crazy, please, numero uno, go take care of your positions that are blowing up on you, and then go take care of your fixed income. I've talked to, I can't tell you how many people who are like, I've over allocated, blah, blah, blah. I'm like, okay, deal with your positions. Are you over allocated because you've chunked too much money into the fixed income, or because you're in cattle or oil or whatever, and it's created a margin expansion event? Don't ignore your oil position that's giving you stress to go liquidate your fixed income. Deal with your position that's giving you the stress, and then immediately go to your fixed income investment and get rid of it. Now, let's talk about that for a minute. So the main advantage of the T-bills and Treasury notes is you get the tremendous buying power relief that we use. We use the Treasury bill, the T-bill, 1 year or less, and we're going to talk about Ameritrade and Schwab. It's 1% or it's 4%. So, excuse me. So in that case, it's pretty easy to sell these things. The first T-bill session goes into how to buy. You can either buy at the primary auction, which is the primary, it's referred to as the primary market, or the secondary market, which is where you go into your brokerage account and you buy what they have in inventory. I don't want to get into too much detail there, but you click buttons and you buy it. If you buy it at auction, you place your order, you wait a day or two until the auction goes off, they settle it a couple of days later, and boom, you're in. If you buy it in the secondary market, you click the button, it's immediately yours. It settles 1 day later, and that's it. So on the reverse end, if you need to sell something pretty quickly, and the T-bill video goes into that, you basically go into your account and you click on the security and you hit the sell button. And your brokerage, when you hit sell, the brokerage company will go out and get a price. It shows you a price, but they'll give you the exact price, and then you click the button if you want to sell it. And then boom, immediately the cash flows back into your account and your situation is alleviated. It's a 1 day settlement, but from my discussion with the brokerage accounts, it's an immediate relief of that margin expansion pressure, if you will. So the T-bills are very easy to liquidate. You just, and again, if you need 90,000 in that example I was using a few minutes ago, sell the 90,000. You don't have to sell the whole 100,000, or maybe you've got 150,000 or whatever your situation. You don't need to really sell more or much more than your actual margin situation. I guess if you need 90,000 in that drastic example, maybe you want to just liquidate the whole 100,000 and give yourself a little $10,000 extra wiggle room because something crazy is going on, and who knows if it's going to expand more actually while you're selling it. So a lot of words flowing out. I hope people are getting that. Let's shift to the T-bill ETFs. BIL and SGov are the most popular. There are others out there. There's USFR. There are a whole bunch of them. And the difference, you have to read a little bit of the description. I don't want to tell people to go out and read the prospectus, but it kind of helps if you glance at it or look at the info sheet on the respective brokerage the respective company who's put out, like BIL, I think is put out by State Street. I forgot who SGov is put out by, but you can go to their website, click on the thing, and it gives a whole bunch of information: the current yield, the average maturity, the number of securities in the account, the net assets in the account, etc. So real quickly, BIL is a 1 to 3 month treasury bill composition. Last time I looked, I think they had 21 securities and it was like $32 billion. So they put big pieces into these things. SGov, I haven't looked at in that much detail. SGov is a 0 to 3 month maturity. So it's 1 to 3 month for BIL, 0 to 3 for SGov. BIL has an expense ratio of like 0.13. SGov right now is waiving, I think, until next summer, part of their expense ratio, and theirs is about 0.07. So you can actually earn right now a little bit more, like 0.06%, if you put it in SGov. If you think about that number, I think it's $6 for every 100,000 or something like it. It's almost irrelevant. So I consider that, and I've mentioned that they're basically the same animal. It's like a zebra. Is it black and white or is it white and black? Well, it's like the same thing. It's pretty much the same thing. Let's get into the margin of these things. So unlike the T-bill, which is 1% margin held back at Ameritrade and 4% held back at Schwab, the T-bill ETF is the margin varies by whether it's a Reg T account or portfolio margin account. It also varies by which brokerage firm you're having your assets. So just a couple of examples. If you're in a portfolio margin account, the Tasty Trade and Ameritrade hold back 7% and release the other 93. So if you put 100,000 in, they're releasing 93,000 that you can use for your equity and index trades. Again, index, for instance, would be SPX, XSP, SPY in our world. There are others, like the NASDAQ has an index that you can trade, etc. I'm not going to go into too much detail there. And again, your individual stocks as well. I really don't want to go into that here. That's a whole different, it's the same, but it just really complicates when you have stocks in your trading account. Again, there's some touching on that in the first video. I don't want to go into it too much. So the different brokerages are different on how they handle that. In portfolio margin, at Ameritrade and Tasty, it's 7%. At Schwab, it's 15%. I don't know why, but that's the way it is. I've had multiple conversations with them. I've kind of warned them, including talking to upper people, that you better get that straight, because it doesn't matter to me, because I kind of have a large account and I don't really care if they're holding 7 or 15%, but it's going to tick off a lot of people. So I'm hoping that is one of those things that Schwab fixes for all of us who have Ameritrade accounts who are going to migrate over to Schwab, which is planned for the end of the first quarter of 2024. Mine is somewhere around March 25th or something like that is my current target date. That target date has changed. It was September, and then it was November, and then a couple months ago, it got pushed back to March. I don't know if they're going to meet their March deadline or not, but these are one of the things that they may need to work on. But we all need to get the basics of what I'm saying here, and Tom is helping me reiterate. But we all have a little bit of homework to do, because we actually have to contact our individual firm to make sure that the numbers I'm telling you apply to you. They do if we're speaking of the brokerages and the ETFs that we're dealing with. Other people use money market accounts. Those have margin relief as well. I'm not going to go into that here. Again, it's in a little bit in the video. It's a different critter, but you get margin relief off of that as well. So the T-bill ETF, BIL and SGov are the most popular in our worlds of these discords, and they are the most convenient. So,
and real quick, I don't know if you hit it, but 7% is what they're going to hold in a PM account, and 25%
Thank you.
is what
Okay.
they're going to hold
But
in a Reg T account.
yeah, so Reg T, at Ameritrade, it's 30% initial and 30% maintenance. So they hold 30%. So for that 100,000 put into BIL or SGov, they're going to hold 30,000 and release that 70,000. I want to reiterate that's in a portfolio margin account. You can use that money for margin expansion purposes. So really, you've got a lot of wiggle room in a portfolio margin account with these index trades. In the futures, you're getting the relief, but it's worthless. So if we have 150 in margin, I want to reiterate what worthless means again. If you have 150 and you allocate 140 into, say, BIL, you've got 10,000 in cash. If your margin expands by more than 10,000, you are then creating a margin loan and you need to liquidate some of that BIL ETF to immediately alleviate that margin loan situation. So, and that's where convenience comes in. So there's a little bit of give, everything's got a gimme gotcha. Everything's a give and take. The T-bill gives you the greatest margin relief, but it's a little more technical and button clicky to get into, either at auction or the secondary market. A little bit more nuance. The BIL and SGov in our accounts, you literally pull it up, you hit buy, you tell it how much you want, and boom, you click. They're free transactions everywhere because ETFs are now free, except for the little tiny regulatory fee. I've had some people mention, well, I'm getting charged. The exchanges charge a little tiny amount, and you guys can look at your own. It's almost invisible for the most part, so it's not to be worried about. You literally click it and buy it and then sell it like a stock. So when I mention this, don't hesitate to liquidate. Pardon the little toilet, but I thought that was funny. It's super easy. So if you have that 140 allocated and you have 150 in margin and you have that 10,000 buffer in cash, and we have a X% pullback or a volatility expansion, and you go to 165 in margin, you basically have to sell another 5% to alleviate that position. You might want to sell 10 percentage points of buying power and to give yourself an extra 5% cushion, because whatever's causing that margin expansion might continue or get worse. But you can just literally click that button and say, okay, my cash went back to positive now. I'm good. Or you can click it and say, oh, I only sold 1,000 or 100 shares of BIL. I need to sell another 100 shares. What at Ameritrade, it's easy. You have your cash and sweep. You can just, if that thing goes negative, I have that here.
All right. So real quick, I'm going to jump in, summarize.
Yep.
Here. If you're looking, the best bang for your buck is obviously going to be to actually trade the actual T-bills themselves. They're going to hold 1%. Okay. And they're going to give you the other 99% to trade with. That 99%. And there was a question in here, what's the difference between cash and buying power, and the difference? It's still using buying power up to your cash balance is, I guess, what we're really saying. So when you're trading futures, yes, it's, you have buying power available, but you can only trade futures up to your available cash balance. If you exceed that, you will start to incur margin problems. Okay, you will start to incur not only margin interest and problems. So it's a kind of you have to check two different things when you're trading futures and trading, whether it's T-bills or BIL or ETFs. If you're trading futures, not only are you looking at your buying power, but you have to look at your cash balance as well. Exactly. Because even though if your buying power could be at 90, however, your cash balance might be at 0.
That is exactly right.
So that's why you have to look at both. It's a little tricky to do, but that's essentially, so if you're really trying to max out your account with just a ton of T-bills and BIL, because you're doing that, you're going to have to monitor your cash balance if you're trading futures. You're trading equities and indexes, you don't have to worry about it because you can go up to the 100% or 99%. But if you're trading futures, you got to watch.
That's exactly right. And again, I know I'm throwing a lot of words out there. It's going to take a little bit of dipping your toe into the water. It's very similar, like I said, to doing all the initial trades you did and the various things that you've done throughout your trading journey. This is just a new little one. The risk is that the government defaults on the security and you don't get your money back, in which case we're fighting each other with sticks and rocks. So the risk is essentially as close to zero as you can get. So the rest is figuring out all this. Well, I'm trading futures, or I'm trading futures in a Reg T account, or I'm trading futures in a portfolio margin account. If you're in a portfolio margin account, and at some point I may start trading futures again, I do trade futures in another account, like I have an oil position right now. I just do it in a separate account from my portfolio margin account, mainly because it's at Schwab, and I won't get into it, but there's some issues there for me right now. Essentially, I have a joint account with my wife. They want me to open a separate individual account to trade futures and put money into that account. Okay, I don't want to go too far there. All right. So again, the convenience of the T-bill ETFs is in that margin expansion moment, you just literally go in there and go click, click, boom, and the cash flows right back in. It's real easy to see at Ameritrade. You look at your cash and sweep. For those of you who are at Schwab and using their portfolio and using the Thinkorswim platform there, it is live. You are able to use it. You are not able to have portfolio margin in the Thinkorswim platform right now, which really ticks me off, but I can't. And that, like I said, is the main reason I'm not trading any futures there right now. But I will in the future. So it's convenience. You get better buying power relief from the Treasury. You get much easier in and out with the T-bill ETF. Again, the T-bill ETF, it's either 30% initial and then 30% maintenance at Ameritrade. Typically, it's 30% and then it drops to 25% in the Reg T account at Tasty and elsewhere. That's something you kind of need to explore on your own. And there's a lot of chatter on this stuff in the fixed income room, so you can kind of look around and see, or make that call yourself, or ping me, and if I can help you, I will. But my point is, if you get in a vol expansion moment, you want to liquidate either the T-bill or the T-bill ETF and look away. Don't worry about it, because as soon as you fix your positions, if you do that in 5 minutes, you can go right back in and buy that T-bill or T-bill ETF back in the amount you need. So if you're under anxiety, if you're under stress, liquidate the whole thing and just go all to cash, fix your situation, and then you'll say, oh, I had 100,000 in BIL and I only needed 20,000 of it. I sold all 100,000 of it. Well, go clickety click and buy another 70 or 80,000 then. There's really not a problem there. So don't focus on that too much. Okay. Tom, what else would you like to cover?
All right, yeah, a couple questions. Let's knock out some questions here. So we got you guys have the basics. You understand how it works. Great thing is, hey, if I buy $100,000 worth of bill, okay, it's gonna hold 25,000 in margin, but you're gonna make $5,000 a year on 25,000 in margin. That's not too bad. If you're in a PM account, okay, you're gonna still make the same $5,000 on $100,000 worth of bill, but you're only gonna hold $7,000. So you're gonna hold $7,000 in margin to make $5,000 there, which is a pretty nice little piece. So let's talk briefly about IRAs. How does this change, Ed, if we're gonna do this in an IRA versus a trading account?
Yeah, great question. And this is where I want to go into these rooms. So the fixed income room here, just go in here and there's a little bit of this. I think this is where so I got a little bit of this, and I think this is where the IRA is. IRAs are cash accounts. They are not margin accounts. So all this, I always say you can only use your cash once. In an IRA, if you over allocate or you have a margin expansion moment, you literally create a margin call. There is no margin loan. So you're going to immediately need to liquidate enough of your fixed income product, either a T-bill or the T-bill ETF, and alleviate that situation. And because you're creating a margin call, and if you ignore it, the brokerage account will take that action into account themselves. I want to spend a minute, and I blew right through that, but there's a thread on this. So here, again, we're in the fixed income room. Here's the little thread thing where there's a whole bunch of little things here. I have the video here. Where do you start your learning journey? That's where the video is. Buying T-bills if you're domiciled outside the U.S. A brief review of how T-bill options work. Again, very much covered in the first section. Got a little bit of my account positioning. I don't think it's really updated, but I've given some like my T-bill ladder. Someone asked me earlier how far I've gone out. I went out to 3 years when the 3-year rate popped above 5%. Rates have pulled back since then. Now I'm kind of going, when I have a maturity, I kind of go out. I fill in little gaps. I actually have a 12, actually a 14 position T-bill ETF ladder. I mean, a T-bill ladder. So depending on where I need to fill space is where I put it. But, and again, let me pause for a minute. The main reason to ladder versus the T-bill ETFs are the quick and easy. If your main concern is, I don't want my brokerage to earn the money, I want to earn the money, just put it in BIL or put it in SGov and don't even worry about it. You're then allocating that excess cash. You're earning over 5% as long as rates stay where they are. I see chatter about, oh, rates are going to be at 2% in a year. I don't know where rates are going to be in a year. No one really knows. But even at 2%, you're still earning $2,000 for every 100,000 you allocate. It's still worth doing versus earning Zippo. So I personally think rates are not going to go down to 2% unless we have a massive economic situation here. I think there's some fundamental reasons that the central banks do not want to get themselves back into a zero interest rate environment because, frankly, it took COVID and the resulting inflation for them to get out of that. And it's a real mess for them because when economic softness happens, they like to cut rates. And when rates are down at 2%, 1.5%, 0.08% on the Fed funds rate, where it was for years, they have no leeway. So they're forced to do QE. I'm going to stop. There's a lot of stuff going on there. I don't think the central banks want rates to go back down exceedingly low. I have a thread here, I mean a pin here, where it shows the historical rate of interest rates. And it goes back all the way to 1990. So you kind of go back and get an idea of the yield curve, which is the interest rate at various maturities, all the way back to 90. So you can kind of see what happened before the Great Recession of 2008, where the crazy central banks jammed everything down to zero and have created great distortion in the economy and to us. I'm sure a lot of you are out there who either yourself or your parents had money in fixed income. Rates go to zero, all that matures. They end up burning through their income, their principal instead of spending the interest. All kind of negative consequences. Debtors are rewarded, savers are greatly penalized. Okay, I won't go too much there, but sorry, it's the economist in me, and that's kind of what I live and breathe in addition to the trading stuff. So I want to get back into the pins, spend some time going through these pins. These are things that either I or here, like here's Gar. Gar found this thing on how to calculate your margin. Like, okay. It's very complex. I don't like doing it. I really don't do it. It's different for span. It's different for portfolio margin. Everyone needs to do their little research. I've got all kind of little things like this historical thing. Here's something on the SIPC, Securities Insurance Protection Corporation. That's what protects our brokerage accounts, very similar to FDIC. Here's some stuff for tasty trade customers. You need to create an Apex login. I'll go into all that in the video. Blah, 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 blah. I've got a whole bunch of pins here. Spend some time on that. I have threads. Again, I don't want to go into these, but they're here. Spend some time on that. Here's circuit breaker rules. Here's my account positioning. Here's my T-bill video that I did with you guys earlier. It's also in that other section, which I pointed out. Here's a little thing on cash allocation, which we're talking about now. Go into that and read it. It's not a ton of stuff. So everyone has to do a little bit of due diligence and figure out for themselves, learn, study, and then come back with questions. I'm here. A lot of other Mr. Top Tickers are very familiar with this. Either they had some idea of it before, very rare few. A lot of them have embraced it greatly. A lot of them have taken their multi-100,000 and multi-million-dollar accounts. I've literally helped hundreds of people earn between thousands and in some cases over $1 million in extra income from this free income stream off of their gigantic trading accounts. We have quite a few members here and other Discords where I hang out that have more than $10 million in their trading accounts. A lot of them had millions of dollars just sitting there unaware of what we're talking about today. It helps everyone. I'm going to take a quick minute and say, what about the people with the $25,000 account? I don't want you guys to feel left out. You're trading, maybe you're at 50%, maybe you're using 12 or 13,000 in buying power. Maybe you're trading the micros. You have $10,000, $12,000 just sitting there not earning anything for you. You can probably take 8 or 10,000 of that, put it into one of these things we're talking about. Let's say you put 10,000 in, it leaves you 15,000 to trade. That leaves you 12.5 in your margin that you're using at 50% and another 2,500 for margin expansion purposes. Leaves you 10 grand that you too can participate. You can make an extra $500 a year. Is it a lot? No, but you go out to dinner quite a few times on it. You can do whatever you want with it. It's your money. You earn it. So even in the smaller accounts and even less than 25,000, I've helped people allocate 10,000 where they're trading 4,000 and they've got 6,000 sitting there. They can take, say, 5,000 of that, put it into BIL or SGov or a little tiny T-bill and leave themselves 1,000 or 2,000 in margin expansion. It applies to everyone, whether you have the smallest little account or the biggest account. It applies to everyone.
All right, I hijacked Ed's screen here just for a quick second to give you guys a quick Fed update. So you can see, and you can also hear that I'm closing I'm closing trades on this move. So you can see the nice little spike here. We have now run up from 46, 46, up almost 10 points in the last couple of seconds with the Fed. They're leaving rates unchanged, which I don't know that has shocked any human on the face of the earth here. I think we all knew that was going to happen. So I guess we'll wait to hear later, but I don't know why we're getting a 10-point bump, but we're back to levels we haven't seen since approximately 11 o'clock this morning. So
good. Thank you for that update. And we'll be signing off in a minute. I actually want to hear what Powell has to say. I personally think he's going to say higher for longer. I think the bond market has gotten ahead of itself on projecting in too many cuts for next year. It may or may not happen. My crystal ball is no clearer than anyone else's. My personal opinion is they're not going to want to cut too much, too quickly, especially if we continue seeing strong economic growth. The unemployment rate just dropped from 3.9 to 3.7 last month. So in the face of these massive rate hikes, we still have a very strong labor market, which creates wage pressure and inflation pressure because there aren't enough employees to fill all the jobs that are available. So as long as that dynamic keeps up, that's what a soft landing is. They can raise rates and slow the inflation down, which it's coming down. It's clearly coming down a lot. If it keeps coming down and we don't have a recession, that's what's called a soft landing. At which point they will start edging off of this, but they're not going to cut a percentage at one meeting next year unless this economy tanks. If the unemployment rate goes from 3.7 to 5% in a month, that'll be a huge recession / massive recession, and they're going to cut the hell out of rates. Otherwise, they're going to want to chip away. Why? Because it's much easier for the Fed and other central banks to hold rates higher for longer and then start edging down real slowly. Because the last thing the Fed wants, they don't want a recession, but way worse than a recession is they let their foot off the brakes too quickly and goose the economy with too fast of rate cuts, and inflation resurges. Because if inflation resurges, if they've cut rates from this 5.25 to 5.5 level, and they've cut them to 4 or whatever too quickly, and here comes inflation back again, they're going to have to go above 5.25. They will basically have neutered a lot of the hard work that they've done, and they're not going to want to do it. So I'll stop there. Again, it's the economist coming out in me. I personally don't think we're going to have a rapid drop off in rates in the first half of the year, even in the second half, assuming the economy doesn't really slow down a lot. And you can kind of watch the employment rate for your main factor there. Keep watching the inflation numbers for those that do. But that's the situation there. Tom, I want to talk one more thing. I kind of said it, but I want to reiterate it one more time. The main purpose of going into treasuries itself is the bigger buying power relief, especially in portfolio margin accounts. It actually makes a difference there because you're getting that 99% relief instead of, say, 7% relief or 15% relief at Schwab. It could matter. It's not critical, but it could matter. Otherwise, and the main reason beyond that is if you feel we are at a point where rates are coming down, which is what I was doing. My T-bill ladder initially last year was a 1 month, 2 month, and then I stretched it out to 6 months. Then I stretched it out to a year. Then I went to 2 years as that rate kept going up for those. We had that inverted yield curve, but is it uninverted? The further out ones kind of had the higher yield. So whenever rates popped above 5%, that's just my little number. It's not really super relevant. 4 3/4, 5, whatever. It's up to each one of us. When you perceive we are at a point of topping out in rates, it behooves us to go out to those longer maturities and lock in those rates for ourselves for longer. That doesn't mean I've jammed everything out at 3 years. I have quite a bit in BIL. A small percent, but enough. That's what I'll liquidate first if I need to liquidate something. And then my treasuries go from like 2 months from now all the way out to 3 years. And again, I have 14 little pieces of those. So I'm just trying to lock in those rates for longer. Some of you are aware of what I do. I trade a lower risk profile than many here. I'm targeting a lower return. I actually target a return. I don't want to get into too much detail there, but I'm trying to lock in those rates longer because that's one of my income. And again, I went into some of this in the first video, but that's my foundation. Like I know I'm going to make that rate. And then how much more do I need to trade LT112 or a SPY put campaign or whatever it is, oil, whatever I'm trading, how much of that do I need to trade to hit my targeted return, which is different in my various accounts. In my biggest account, I have the smallest targeted rate. In my medium-sized account, I have a higher, more aggressive rate. Again, that's for each of us in our own trading plans. But the main reason not to use BIL and SGov, for instance, is if you want to, I hate to say play the interest rate scenario, but that's what it's for. If that's above your understanding or concern, just put it into BIL, put it into SGov. If you're trading futures, it really doesn't matter. Leave yourself a cushion in cash for your margin expansion and enjoy the free money stream, whatever interest rates are. For, like if it's 5, great. If we drop to 4, you're still earning 4. If it goes to 3, whatever, it's worth doing no matter what. So I guess I want to conclude with that. I hope we've reviewed everything enough for everyone to at least get a general idea or reinforce if they've been exposed to this before, if they've been around for a few months, view the other video, and or been hanging out in the room. It does take a little bit of groundwork and a little bit of roll up your sleeves, learning just like it did when you traded options and futures and even individual stocks and mutual funds. No one just went out and said, I'm going to buy this stock today. Well, maybe someone did, but all these, the technicalities of execution need to be understood. So this is this is what I'm talking about here. It's worth it. Again, for every 100,000, over 5,000 a year. For every 10,000, it's over 500 a year. It is worth your time to learn these little things that we've discussed today. With that, I guess I'll stop.
Yeah, good. So I think Ed, appreciate all the help here. I think bottom line is understanding what are you trading. So if you're in an IRA, it's cash for cash. It's it's cash secured. You're not getting any real relief. You're just able to invest in T-bills or T-bill ETF or something like that, and it's going to be cash secured. Obviously, it's a safe investment, and it may be a portion of your retirement portfolio in an IRA. If you're in a Reg T account, T-bills are only going to hold about, 1% of margin, freeing up 90%, 99% for you. And if you're using a BIL ETF or something like T-bill ETF, it's going to hold about 25% against your margin. The only thing you have to be aware of is watch your cash balances because of futures. If you're in a PM account, you're going to see the big difference is going to be when it comes to BIL, not really when it comes to T-bills, but
Right.
because T-bills is 1% hold either way. Okay. And the only difference in a PM account is if you're going to use the BIL ETF, you're typically going to have a 7% margin hold-ish, depending on what broker. You're using 7 to 15%, somewhere in there, and it'll free up the other 93% or 90% or so for you to use on equity and index trades. And I hope that makes sense there. If you just kind of think of it that way, that in an IRA, not a huge deal. It's just a good income generator of safety. If you're in a Reg T account, it's a good opportunity to use that unused cash balance. Okay. And build the ETF is easier. And for me, I'm lazy and I don't want to go purchase T-bills. And I don't want to have to sell them one at a time if I need to free it up. I just rather sell 10 grand worth of BIL and be done with it. Understanding the fact that I'm really giving up a ton of margin use by using BIL at 25% of margin versus 1% on treasury bills and buying them individually. I'm giving up a lot of margin. And if I was, wanting to take that next step and be a little bit better, you would technically be buying the actual treasury bills themselves, learn how to do that and purchase them individually. You can get in and out, which I think is the other thing to remember here, that if your margin spikes, whether it's span margin or it's something else that happens with volatility, you can get out of either one of them fairly easily. And then there was somebody posted in here, well, how come it's showing 50% at Tasty Trade? Because the 50% is your initial margin, 25% will be maintenance margin. So it will come at 50% today will turn into 25% margin hold tomorrow after it settles or in like the next 2 days or so. So just so you're aware. Anyway, I hopefully that sums things up a little bit. The last thing here is Ed's got so much great content in the in the service here. Just go through, scan. You can do some searches. You can look at the different posts, the different pin things he's got there. He shared a lot with you. I would think almost any question you would ask at this point, there is already an answer for it. It's just somewhere it's posted there, and you got to search for it a bit. If not, you can certainly ask, and he'll help you out.
Again, Tom, thank you. It's been a pleasure. Always happy to jump in and love interacting with the Mr. Top Tickers out there. So you guys have a great trading day and have a good rest of your week. Perfect.
Thanks, Ed. Appreciate it. That was really good stuff, and hope you guys got something out of this. Put your unused cash to work. Okay, you'll see it's built into my new trade plan as well. But if you're going to be using BIL, the ETF, as Ed mentioned, start small, like 10% of your buying power, and then just start to add until you figure out where that tipping point is. For me, it's right around 25 to 30%. If I exceed that, I start to incur margin interest. So everybody's got to figure it out. Good stuff. We'll see you guys all in the Discord. Thanks again, Ed.
Bye, guys.
Awesome stuff. Great.